made simple, and a special welcome to 2026. It's a brand new year, and before we dive into what the market has in store for us all this year, I want to quickly take a moment to talk about what happened last year. 2025 was a wild year for the country, for the economy, and for the stock market. And I wanted a chance to be able to chat with you all to take a look at what changed, how we can learn from it, and see where we should be focusing our time and attention moving into the new year. Before we get into it, real quick disclaimer, I'm going to share my opinion today about some different current events, things that are moving the market, and more. Those are very much my opinions. My goal in doing this webinar is to share with you how I've come to these opinions and how I've made these decisions or these opinions in the hopes that you can make a more informed investment decision for yourself. And as always, past results cannot guarantee future performance, which is why it's important that we do our own research before making investment decisions. All right, disclaimer and all the boring stuff aside, let's get into what changed in the stock market in 2025. In this webinar, we'll take a look at which market sectors offered us the best and worst returns in 2025, what global events shaped the stock market as we saw it, which sectors fared the best and worst specifically in the month of April 2025, because that was a pretty wild month, and we'll cover why. And then we're going to shift a little bit to talk about our matrix strategies and highlight a matrix strategy that performed incredibly well throughout 2025 and continues to be the leading strategy today. And then finally, we'll take a look forward at 2026. We'll see which sectors are the leaders moving into the new year, and I'll talk about my personal opinions of which sectors and areas of the market we should be keeping our eyes on moving into 2026. Let's start off, though, by talking about how we got here. What happened in 2025? Well, from the 50,000-foot view, the S&P 500 closed the year up 18%. This is well above the 5-year average between 2021 and 2024 of 13%. When it came to which sectors performed the best, sensitive sectors such as communications, XLC, technology, XLK, and discretionary, XLY, offered the best returns. But these sectors we traditionally think of as being sensitive sectors. The reason is that they will move quite a bit more than other sectors in the market. Especially, they will move more than the defensive sectors. So, while communications, technology, and discretionary, if all we cared about was how far from point A they ended up at the end of the year, yes, they were the leaders. But during April, which is one of the most wild periods in the market, these three sectors experienced the largest losses. So it was not smooth sailing for these three sectors. They had to fight to earn their results for the year, and we'll take a look at that in a little bit more detail later on. But within April and throughout the year, two sectors really stood out as being protected against all of the ups and downs that came with the year. While these sectors definitely were not as high when it came to one-year returns as the sensitive sectors, communication, technology, and discretionary, our defensive sectors in healthcare and utilities definitely held up their end of the bargain. They offered fairly strong returns of around 14.5% to 15%, but more importantly, these sectors were much more consistent. They didn't have the same massive price swings, both positive and negative, that other sensitive sectors did. Now, not everyone could be a winner in 2025, and two sectors that lagged behind the rest of the market were staples and real estate. Both of these are for different reasons. Real estate, a little bit, we're not really going to get crazy into why real estate went down, so I'll give it a little bit more attention right now, because then we're going to kind of forget about it. Real estate didn't have any good news, basically. What it came down to was that rental markets are in a little bit of a rough spot. Mortgage rates are still fairly high, and while rates are beginning to go down, federal interest rates are beginning to go down, the real estate sector has not really had a chance to play catch up. Staples, that sector definitely had a lot more going on. And part of the reason that it lagged behind the rest of the market was because of tariffs. Common theme that we'll talk about. So, beyond what sector were the leaders and laggards within 2025, I want to talk about two major events that moved the market. Not just in one little period of time, these were two of the largest events that kept coming up throughout 2025 and are the main reasons why the market is what it is today. First, this is going to come as no surprise. We have NVIDIA, the semiconductor industry as a whole, and the reason that they are the talk of the town, AI. In 2025, while the S&P 500 was up 18%, the semiconductors ETF, an industry within technology, was up 43%. If you're interested in the semiconductor ETF, by the way, the ticker symbol is SOXX, SOXX. But within the semiconductor industry, within technology, there were a lot of companies that had some incredibly powerful years. We had NVIDIA, which was up 35% and rose to become the world's most valuable company. Also, other smaller companies such as Broadcom, AVGO, was up 48%, Intel is up 98%, and Micron is up almost 300%. So the AI boom has really been a rising tide that has floated many of different boats within the market. And as we'll look at in a little bit, it is not limited to just the technology sector. Other companies within other sensitive sectors and even some defensive sectors have seen some fairly large gains as a result of the AI craze. But will it continue into 2026? That's a big question that we would want to try and find an answer to. The other one is tariffs. Tariffs have been a massive, massive strain across the entire the entire year of 2025. Some tariffs were announced as early as February, but the real big stuff is the Liberation Day tariffs, or are the Liberation Day tariffs that began in April. These tariff announcements within April led to 4 of the 10 worst days for the S&P 500 as far as points are concerned, not percentage. But in the wake of all of those losses, there was a rainbow at the end of the thunderstorm, because 4 of the best 20 days, and actually the best day in market history, as far as points are concerned, happened in the wake of these tariffs. So, tariffs were very much something that took a lot away, but gave some back. So let's talk tariffs. Tariffs and trade wars were one of the biggest themes, both positively but also and mostly negatively within 2025. Because what a tariff is, if you're not familiar or you just want to be able to follow along, it is a cost, a tax that is put on things that we import into the United States. So if we take something from Canada and we import it into the US, there is a tariff that is charged. This tariff is paid by the US company importing that thing, not by the exporting country or the exporting company. But most importantly, the reason we have tariffs, the reason that tariffs are typically used is to try and protect US companies. It's to try and say, we can make this here, but they can make it cheaper. So we can add a tariff to something that we would import to try and make the costs similar so that US companies can grow, US workers have jobs, and our economy grows as a result. That's not exactly what happened in 2025. Starting in February, the United States didn't use trade or protecting US industries as a reason for tariffs. Instead, they started using tariffs as a way of punishing countries that they felt were not holding up their end of the bargain when it came to things unrelated to the economy, like, well, pretty sure this video would have a lot less traction if I said what it actually was, unfortunately. But there's a lot of products that were coming into the US that are very damaging and very illegal. That was the reasoning for the tariffs on Canada and Mexico, as well as China. And while this began the trade war, things really got bad in March and April. In March, this trade war escalated and caused the 13th worst day for the S&P 500 on March 10th. And of course, because these tariffs are not something that are planned out for months or years in advance, they were something that were changing by the day. Well, 4 days later, on March 14th, the S&P 500 had its 8th best day in history. This first down and then up thing, it's going to be a common theme when we're talking about tariffs. But all of this was just the appetizer for what came up in April. Because what came up in April, oh boy. Welcome to Liberation Day. On April 2nd, Trump announced what he called Liberation Day tariffs. The goal of these tariffs was to try and punish other countries that Trump and his administration believes were being unfair to the United States, where they're charging us crazy tariffs on products that are exported from the US. Why shouldn't we do the same? At least that was the idea in theory. But how did the market respond to this? Well, not well. April 3rd and April 4th, the 2 days after this announcement, those were the second and third worst days in S&P 500 history, only beaten out by the beginning of the pandemic on March 16th of 2020. Between these 2 days, the market single-handedly went into a correction, meaning it lost more than 10% of its value in 2 days. Also, market volatility skyrocketed as investors were panicking, not knowing what's going on, how long these tariffs were going to last, and how far those tariffs were going to go. In fact, market volatility jumped to its third highest level in the past 20 years. And there's pretty good reason for the panic. These tariffs, these Liberation Day tariffs, were the most severe tariffs that we've seen in almost 100 years. The only time that it was worse was in the wake of the market crash of 1929, where the US imposed blanket tariffs across the entire globe. And those tariffs caused global trade to decline by 60%, is part of the reason why the Great Depression became the Great Depression and is widely considered one of the worst economic decisions in US history. Why am I saying that? Because these were blanket tariffs. These tariffs were put on all countries and all products, regardless of if we can even make that product here in the US. The bigger problem? These reciprocal tariffs, where you are giving us a tariff, so we're giving you one back, weren't actually tariffs. If you want a full breakdown of what was going on with that decision making, I have an entire video where I talked about the tariffs back in April, available here on our YouTube channel. But the long story short of it, they weren't tariffs. The numbers that they used to make these tariffs were simply trade imbalances. For example, Thailand. We buy more stuff from Thailand than Thailand buys from us. That's not a tariff. That is just, we buy more stuff from them than they buy from us. But that trade imbalance was what was used to decide that Thailand should have a reciprocal tariff above 70%. It also resulted in some islands that are by no means an economic powerhouse having some insane tariffs as well. Well, how did the market respond besides having two of the worst days in the S&P 500's history? Defensive sectors, well, they held on the best. They only dropped around 7%. Most other sectors fell between 10 and 14%. And here's where things go from weird to absolutely crazy. Because 1 week later, on April 9th, Trump announced that most of the Liberation Day tariffs would be paused for 90 days. A 10% tariff on all countries and all products still stayed in place, and there were higher tariffs still placed on China. And the market, just as much as they had panicked the week prior, had an absolute fiesta. Because April 9th has gone on to be the largest single point gain for the S&P 500 in history, and it's not even close. The S&P 500 jumped 9.5% instantly. That is absolutely ridiculous. Now, obviously, these are things that happened over a few days to a few weeks, but by the end of April, once all the dust had settled, the market, for the most part, hadn't really changed too much. The S&P 500 and most market sectors closed around 1% above or below their starting price. Technology had the biggest gain at 3.4%, and poor energy had the biggest loss at 12.9%. So, tariffs were something that came and went within April, or at least they paused for 90 days, until they reared their heads again in August. So, why should we care? Because April, August, that's old news. Well, the reason is that what happened in April was far from normal. Again, tariffs like what we've seen, and honestly, what we have, are some of the highest tariffs in history. And a lot of the decisions going into making these tariffs still to this day make zero sense. With some going as far to say that they asked ChatGPT for how to solve this situation. And ChatGPT gave them the formula, or rather, if you asked ChatGPT, how do you solve this? It would give you a formula that is almost the same as the formula that the White House published as what they really used. Before ChatGPT then tells you that this is not a good way to solve the problem. So this is how we tried to solve the problem. But beyond it just being far from normal, it highlights a few key points that I want to share with you. Because while April was not normal, there's a lot we can still learn. First off, market structure. The idea that certain sectors and market cycles, certain sectors perform better than others during different parts of the economy and different parts of the market, that didn't fall apart. Sensitive sectors saw the biggest losses, but also saw the biggest recoveries. Defensive sectors saw the smallest losses, but also the smallest recoveries. This idea that sensitive sectors are more volatile than defensive sectors on average, even with all the craziness going on in April, still held true. We should care because that means that understanding market sectors, sector rotation, and tools like the sector strength matrix, here at Sectors Made Simple, have a ton of value. Because if market structure and market cycles hold up through Liberation Day tariffs, it can weather almost anything. And then the other one is a little bit more ominous. Tariffs are still here, but in a much more muted way. And they could come up again. It's always possible that the Trump administration goes back to tariffs being their choice of solving conflict, negotiation tactics, carrot versus a stick, whatever you want to call it. Tariffs are very much still part of the conversation. Trump still has the power to put tariffs into place temporarily. And understanding what happened in April to the market can help us prepare. Because if tariffs come up again, we understand what parts of the market would be a little bit more protected, with no idea of when that recovery might begin. Because while these tariffs lasted about 7 days at first, there's no telling what would happen again. And that leads me to the final point, which is, why did Trump decide to pause the tariffs after only a week? Well, because bond markets were freaking out. Stocks are one type of investment and are a common type of investment, but another very common type of investment is debt securities, aka IOUs or bonds, where the federal government can issue bonds to collect money and then pays interest on those bonds. When the economy is freaking out, bond markets also freak out. And these bond markets were borderline collapsing in the wake of Liberation Day tariffs. Which means when Trump was influenced by big money and institutions that had money tied up in bonds, that was a large reason that the tariffs were paused. Which means that big money and institutions still have a lot of power and a lot of say in these tariffs. And that's very important for us to know. And again, bond markets are not the stock market. And that's a good thing. Because when the market's going down, many investors do look at things like bonds as a safe place to put their money. So knowing that bond markets and the stock market are something that's still being thought about is really relieving from the investor side of things. I do have to mention, we're always thinking about these ideas from the economics or from the stocks point of view. It's hard to really cover everything else beyond that. So, 2025 in a nutshell, AI boom, tariffs. But what about matrix strategy? If you've been around Sectors Made Simple for a little bit, matrix strategies are probably a term that you've heard of. These strategies are meant to be a simple way of trading one thing once a week, following a strategy, and seeing how it performs. And throughout the year, I've covered the basics of matrix strategies, how to pick the top strategy, and more. So I feel like it's only fair that at the end of the year, we look back and see if there is one matrix strategy that has stood out, and more importantly, has offered better returns than the S&P 500. And, in fact, there is one strategy that meets those criteria: the Wednesday long-term strength strategy. This strategy has consistently been one of the top strategies, and in 2025 really showed that. It has the best one-year returns for the past year, the past 6 months, and even the past 3 months. Meaning it didn't just get lucky in April and then has been doing nothing ever since. This is a strategy that was, has been, and still is an absolute leader. For some numbers, throughout 2025, while the S&P 500 offered that 18.5% return, the matrix strategy, trading one thing once per week, had a return of 44.1%. Also, over the past 3 months, so that's only October, November, and December, while SPY has been up 2.9%, the matrix strategy is up 7.2%. Now, if you're looking at this strategy and you want to try it out for yourself, let me show you where you can find it. Over on the dashboard, which is available to Sectors Made Simple subscribers, under strategies, you can find a list of the 8 different strategies that we currently have. And if we sort these results by 3-month returns, 6-month returns, or 1-year returns, the same strategy continues to pop up as the leader: Wednesday long-term strength. This strategy currently is holding XLI for this week, and it updated today, January 6th, 2026. So how you would trade this strategy is that you would go in, and during market hours on Wednesday, because again, the strategy updates before Wednesday, I would go in and buy XLI. Then if I wanted to follow the strategy the following week, I would come here, see what it's now holding, sell the old sector, buy the new one. But it's even easier. If you don't want to actually remember to come to the dashboard or set an alert to go check, we can send you an email. We can send you an email at the close of the previous trading day, which is Tuesday after market close for this strategy, or the open of the current trading day, Wednesday morning, letting you know that the strategy is updated and it's currently holding industrials, XLI. So, this matrix strategy has continued to be one of the top performers, offering higher reward and better risk historically than the S&P 500. And again, this strategy updates after market close on Tuesday because it trades during the day on Wednesday. The backtesting, by the way, for the sake of completeness, these returns assume that we're using the close price on Wednesday. So 44.3% return is using the close prices for the different ETFs on Wednesdays. So that's the strategy that led throughout 2025, and as we could see, is continuing to be the top performing sector strategy. But beyond that, which sectors are the current leaders? Well, currently, financials is in 3rd place, ticker symbol XLF, with an overall strength of 13. Industrials and healthcare are tied for 1st, which is XLI and XLV respectively, both with total counts of 16. So, financials is in 3rd, and a 2-way tie between industrials and healthcare for 1st. But that's only one way to look at sector strength. because sector ETFs are very valuable. If you see a sector as a leader, you can buy the sector. But it doesn't really tell us the performance of the average company within that sector. Sector ETFs will give more value to the bigger companies as opposed to the smaller ones. That's why they are valuable if we want to buy the performance of that sector. So instead, or rather in addition, a different way we can look at it is to see which sectors have the most companies going on buy signal or breakouts. And if we do that, two sectors, industrials and financials, have BPIs above 70%, meaning 70% or more of the companies within those sectors are currently on breakouts or buy signals. Now, you might be thinking, that's a good sign, right? Really high BPI is a good sign. It's a sign, but to me, I don't think about BPI, and traditionally, BPI is not thought of as the higher the number, the better. It is not like saying price. It's a way of saying risk, where the higher the BPI, the higher the risk if that sector begins to go down, because there's a lot more room for it to fall. So when I see personally industrials and financials have BPIs above 70%, that makes me a little bit more cautious. It's not to say that they're about to go down or they are going down right now. But what it means is that there is more risk for them to go down or to continue going down if they show some weakness. The opposite, though, is also true. As sectors begin to go down, more companies are falling out of those buy signals and are reversing into sell signals. That creates more opportunity. So it's also valuable to highlight which sectors have BPIs that are currently going down. Because when recovery in those sectors begins, there's more room and space for growth. So, while these are not leaders going into 2026, in my opinion, these are the sectors that can show the most opportunity. They are utilities, which is currently at 45.2%, communications at 47.8%, technology at 53.6%, and discretionary at 55.1%. Remember, all of these BPIs are currently going down. That doesn't mean that right now is the right time to look at these sectors. What it does mean is that when recovery begins, these are the sectors that can probably grow the most and the fastest. So, how can we use that information? Well, I'm going to give you an example. And an example that we could actually use. Going back to April, if we think about what I talked about earlier in this webinar, no, don't go and pause it and then try and rewind it. Give us the refresher. Sensitive sectors, communications, technology, and discretionary are the most volatile. They had the biggest losses when the market was panicking, and when the market decided to try and pick up all the pieces, they were the ones to see the biggest recoveries. Which means these are the sectors that create the biggest opportunities when recovery begins. And guess what's happening? Not right now, but what could happen in the near future. Recoveries within these three sensitive sectors: communications, technology, and discretionary. One way that we can try and act on that information is using another one of the tools from Sectors Made Simple, the S&P 500 screener. Here, we rank all S&P 500 companies from strongest to the weakest. and we can learn a little bit more about them, such as if their price is currently going up and if they're on those breakouts or buy signals or not. So a filter that I'm going to show you is going to be setting the sector filter to technology, discretionary, communications, only looking at companies that are in breakouts and are currently going up, positive direction or an up arrow. Let's go together and do that. So on the S&P 500 screener page, what I'm going to do is I'm going to go over to the filters, and first we're going to use this sector filter. We're going to set it to communications, discretionary, technology. Next, I want to find companies that are on breakouts. Why? Well, this is assuming that these sectors are recovering. So I don't want to find the sector that has recently gone on a sell signal. I want to find the one that's recently gone on that breakout or buy signal. And then finally, of course, I want the thing to be going up in price. So sectors, those three sensitive sectors we just talked about: signal, breakout, direction, up arrow, going up in price. And the last thing for us to do is to sort those results by signal date. What date did that breakout happen? So that we can see which ones have happened most recently. Right now, it is January 6th, 2026. That's going to take a bit of getting used to. This information is as of market close yesterday. This information updates in the middle of the night. So right now we're still looking at Monday's results. But what we saw on Monday was 10 companies, 12 companies go on breakouts just yesterday alone. Some of these companies, if we look at total count right here, higher percentages, higher strength. More green box, more strength. Some of these companies are leaders. For example, AMAT, it is beating 92.4% of S&P 500 companies. KLAC beating 92.6% of S&P 500 companies. MPWR, 49%. So not only can we see when companies are going on breakouts and be able to see which companies have recently gone on breakouts, we can also help narrow down how many choices we want to consider by only caring about the ones that have the highest relative strength. Why this is valuable is that there's no crystal ball for the market. The best thing we can do is make informed investment decisions. And the more things that we can find that are saying there is a chance, there is a better chance, there's an even better chance that the price is going to continue to go up, the better. We're finding sectors that are trying to recover, not ones that are already overbought, meaning higher risk. We are looking to find companies that have recently gone on those breakouts. And by recently, I mean literally yesterday. Their prices are still going up, and we can then narrow down the final list of choices by which ones are the strongest overall. So, this is a filter that we can use at any time and in many different ways. But the reason I wanted to highlight it right now is because of those three sectors currently having more companies going on breakdowns than breakouts. Recovery is never an if, it's a when. With the S&P 500 screener tool, It's pretty easy to see the when happening in real time. Jonathan, in my platform, the direction does not show me the arrow. It shows me an X or an O. I assume the X is the arrow, correct? Yes. So under the hood, by the way, we're going to go into a little bit of behind the scenes magic right now. Underneath all of these up arrows and the simple kind of information on sector summaries is a type of chart known as point and figure. Point and figure tracks price over trends through uptrends and downtrends. If you want to learn more about point and figure, this is available to anybody regardless of if they have a subscription or not. We have learning paths available on learn.sectorsmadesimple.com under fundamentals and tools, and tour, I believe. Let me actually take another try at that. It's under finance fundamentals and charting. Here you can learn about different types of stock charts, including point and figure, which is what we use to build many of the tools here at Sectors Made Simple. I'll put the link to that in the chat, as well as it will be down in the resources of this video if you're watching it recorded. The reason I'm going through all of that is in the settings menu on the dashboard, in addition to the very important dark mode, thank you, there is display P&F trend info. If you tick that, then when you look at something like the sector summary, your trend or your direction has now become point and figure column, and it will use X's for up, O's for down. If you don't want to see the demonic game of tic-tac-toe, turn that setting off, and it'll go back to being up arrows and down. Great question. Thank you, Maria. So, we've shown some areas of the market that have the potential for opportunities, and we've highlighted a simple way that we can try and find those opportunities as they come up in real time. But let's ask a bigger, higher level question. Is the stock market overvalued right now? Are we worried about a bear market beginning soon? Or a correction? Unfortunately, I can only really give you my opinion and some data that I've used to make my opinion. So here's some of that data. Moving into 2026, the objective answer is that S&P 500 companies are very highly valued, or in other terms, are very expensive. One way to figure out how expensive a stock is to use its P/E ratio, or price to earnings ratio. That's to say, for every $1 of profit or earnings the company creates, how much do you have to pay for it? Right now, the answer is, for the average S&P 500 company, for $1 worth of earnings, you'd have to pay $29. Cool. What's that mean? Well, let's compare to what's happened in the past. A P/E ratio of just around 30 is pretty rare to see, and in fact, has only happened 3 times in the past. Technically 4. In 1999, before the dot-com bubble burst. A bear market in 2002, the Great Recession in 2008, and the pandemic. This one is the technically in 2020. These 4 times we have seen these P/E ratios skyrocket. And the reason I say kind of with the pandemic is that part of that is earnings. How profitable are these companies? And the pandemic caused massive, massive changes in earnings. with a lot of companies having to shut down operations partially or entirely for long periods of time. When earnings go down, even if the price doesn't change, all of a sudden the P&E skyrockets. So we had 2 times, 1999 and 2002, where the P&E went above 30 before the market crashed or went into a bear market, a loss of 20% or more. And then 2, where it happened after a recession or major economic event. So, is a high price to earnings ratio a doomsday sign? Are we just waiting for the market to collapse? No. There's as many signs that this is not a bad thing as opposed to it is a bad thing. But that does mean, in my opinion, it's something that we should pay attention to. A high price to earnings ratio could just be the way the market is now. Or it could be a sign that things are becoming overvalued. And then lastly, can it actually stay above 30? It's very possible. And let me show you why. Again, this is my opinion, and I encourage you to make your own opinion from this as well. What we have here is a chart showing the price to earnings ratio of the S&P 500 over the past 80 or so years. While yes, we have seen those spikes above 30, what we've also seen is that there is a pretty strong trend of stocks gaining more value over time. And even when there's a massive correction, like what we saw before the stock market collapsed in the Great Recession, we don't really go back to that normal around what used to be 7.5. Normal could now be 20, 25, or even 30. This trend does trend positively over time, or at least it has since the early 80s. So when I see someone freaking out because the P&E ratio is above 30 for the first time, to me, it's possible, it's not promised, but it's possible that it's as simple as someone also saying, oh, I remember when the price of gas was 50 cents. It's now $4. Yes, it is $4, but the value of things can change over time. And it's possible that 30 is just the new 20. At least that's what I try and tell myself after turning 30. But for the stock market, it might be asking the same question. So again, price to earnings ratio is something I'm keeping my eyes on because it is something notable, but isn't some writing or some horrible sign of things to come. So now let's talk artificial intelligence. Also, Gina, yo veo tu pregunta sobre petróleo. Claro que sí, voy a hablar un poco sobre petróleo en 5 minutos, más o menos. Pero también la energía nuclear es un tema un poco diferente porque estas compañías no son un parte de energía, pero no son la mayoría del valor de energía. La mayoría del valor de XLE y el sector de energía son compañías de petróleo y más. Really quick to translate that answer to English. The question was, will I talk about petroleum and oil and energy, predominantly nuclear energy? The answer is I will talk about petroleum a little bit, and we'll talk about that a lot, actually. But the nuclear side of things is a little bit of a different conversation because right now we're looking mostly at the high-level sector stuff. What is moving the energy sector, XLE? And predominantly, that is oil companies. Unfortunately, uranium is a very small part of that sector. And it's very fascinating. I actually have entire webinars where I've talked about the uranium industry subsector, and it is super, super cool. And it's something actually I would love to talk about again in the near future because it applies to AI. But unfortunately, that's not something I'm diving deep into today. But I love that idea. I'll cover it in a webinar in the next couple of weeks. Me pasó lo siguiente, no sabía que era un split y me pasó con Lucid y TVE una grande pérdida. ¿Cómo enterarse cuando va a pasar esto? Esto es una conversación muy diferente porque cuando estamos pensando, cuando estamos hablando sobre compañías, tenemos maneras diferentes para analizar sus gráficos, las tendencias de la compañía, el sector, la bolsa en general y dónde podemos poner cosas como trailing stops para vender si la compañía está bajando 5 o 6%. Pero, Josefina, quiero hablar un poco más contigo sobre esto. Puedes enviarme un email a support@sectorsmadesimple y podemos, si es posible darme un poco más información, claro que sí, podemos hacer un discurso sobre esto. Okay. That question was talking a little bit about what's been happening with a couple of companies having reverse splits and losses as a result of them. Typically, companies going on stock splits is viewed as a very positive thing because the company's price is growing to the point where they want to make the share price more affordable. You've seen it happen with companies like Disney, Tesla, and even things like sector ETFs like technology. The market also views reverse splits in the opposite way, where if the price of a stock is going down beyond where the company wants it to be because of the company having weakness or perceived weakness, then having to actually do that stock merge or that reverse split is seen as a negative sign. So that's my basic answer. But if you can give me an email at support@sectorsmadesimple, I'd love to talk about that in a little bit more detail with you. But for right now, let's dive into the last few topics for today. AI is probably the biggest unknown in the market. AI, I don't think you need me to describe because right now it is what everyone is talking about. It is either a booming industry or a bubble waiting to pop, depending on your opinion. We already talked about the S&P 500's price to earnings ratio of 30. Well, the two sectors that are most heavily involved in AI would be the technology and communication services sector. And they have price to earnings ratios of around 39, even more. And semiconductors, well, their average price to earnings ratio is 47. Now, long story short, do I think AI is a bubble? No. And in fact, I have an entire webinar where I've talked about this in a lot of detail. So if you're interested, after this webinar, I'd recommend checking that out. But I do think that AI companies, both ones that are involved in producing the hardware for AI, the AI itself, or are powering AI, have a lot more risk or have a lot more potential for risk than reward. They're already being rewarded a lot, and investors aren't waiting to get more good news about AI. They're just waiting for the reason to panic about bad news. The other part is right now, investment into AI is massive. It is very normal to see massive investment of billions of dollars into smaller AI companies or building up more data centers for AI. But AI growth and revenue growth are two different things. For example, OpenAI, the company that produces ChatGPT, there's a lot of growth of what ChatGPT can do, but OpenAI is still spending more money than they're making. That could be seen as, well, first off, OpenAI is a private company. But I use that as an example to show that a company that is having billions of dollars thrown into them are still potentially turning losses. And right now, investors don't really seem to care. If there is the promise of growth and the potential for growth, there will be money thrown at them. But eventually, we need to see some revenue growth if investors are going to continue thinking AI is the answer to everything. And then the other main topic is energy. This is the other major unknown. And unfortunately, I don't have a lot of information about this because this is still something that's going on right now. In the wake of the Liberation Day tariffs, we saw that energy was the only sector that was struggling to recover. And it's had a pretty rough year. It's been the topic of a lot of conversation and is even more important right now because of the US's recent involvement in Venezuela. Now, Venezuela is a very interesting country for oil because it has one of the largest oil reserves, meaning they have one of the largest amounts of oil in the world, around 17% of the total amount. But they only produce around 1% of the world's oil products, meaning a lot of oil is in Venezuela that is not being extracted or used. Now, again, I have to detach current events from if it's right or wrong. We're not here to talk about that, unfortunately, or fortunately. All I can say is how this might impact stocks. How it might impact stocks is the fact that US oil companies are at the center of this conversation. Trump has confirmed that US oil companies were aware of the US's plans to capture the Venezuelan president Maduro even before that operation happened. And he's continued to talk with them about how they might be able to extract more oil from Venezuela. If that happens, that's going to cause a massive change in the supply and demand of oil across the globe, and of course, US companies that are involved in oil as well. But in what direction? That's the billion-dollar question. So, a lot happened in 2025. For some betterment, some worse, but overall the stock market surged, well above the 5-year average. The market continues to provide opportunities, and sensitive sectors are currently on a pullback, creating some room for opportunity and growth in the near future. There are still many questions that we have to ask, such as, is AI a bubble? Will we see the bubble pop? And what is in store for energy companies for Venezuela and for global trade as a whole, with oil prices and tariffs at the center of it? But unfortunately, that is all the time that we have for today. I want to thank you all so much for joining us back here for our first webinar of 2026. For all of those that join us for our Thursday SM Espanol webinars, there will not be a webinar this Thursday. We will pick up with those webinars starting off next week on January 15th, 2026. Voy a repetir esto en español. Esta semana no vamos a tener una reunión de SM Español en jueves. Vamos a tener la próxima reunión de SM Español en el jueves siguiente, el 15 de enero. But until then, I want to thank you all so much for joining us. If you have any questions or anything you want to chat with me directly about, you can always send me an email at support@sectorsmadesimple.com. Thank you all so much. Welcome to 2026, and we'll see you all back very soon.